Good afternoon and welcome to the first quarter capital markets webinar. Before we get into today's remarks, we're proud to share that we were the Refinitiv Lipper Awards winner for the US 2023 Best Overall Fund Family for a Small Company over the trailing 3 years. During these 3 years, we've navigated some pretty unprecedented and historic events. And these awards, which are granted annually, highlight funds and fund companies that have delivered superior firm-wide performance. There's nothing more important to us than delivering results for our clients, and we thank you for your trust and partnership over the years. So with that said, guys, my name is Jake Symoniak, and I'm a senior analyst here in the Global Strategies Group at Manning & Napier. I've been with the company for over a decade, and today I'm happy to be joined by Beth Mallette. Beth is the managing director of our capital goods team and a new member of our core team here at the firm. And on her role with the core team now, she's a member of a 3-person team charged with making portfolio management decisions, specifically in our core equity products. So Beth, first of all, welcome. And second, I was hoping you might be able to just give us a quick overview of what it is you're doing in your new role.
Sure. Yeah, thank you very much, Jake. I've been with the firm for 16 years, and I spent a decade of that time managing our real estate and our equity income series. So, this is a move back to sort of what I would consider more my wheelhouse. I still love the bottoms up, stock picking work that I do, and I'll continue to do that as a part of the capital goods, group, which I'll continue to lead. But I'm very excited to be back on the portfolio team side of things. Of course, it's an especially interesting time to be joining the portfolios. Never a dull moment for sure. But that's what I love about this job. I do think that my experience, with the more cyclical parts of the markets, will hopefully be a good thing to bring to the table in this environment. So yeah, I'm really happy that you've all joined us today. I'll kick it back to you to turn things over and get things started, Jake.
Yeah, so just quickly before we get into it, I'll kind of lay a roadmap for what it is that we want to accomplish today. So our plan from here is to proceed as follows. First, we're going to walk through our economic outlook for the US and kind of where we see equity markets now and how they might be evolving in kind of the coming months and quarters. From there, we'll briefly discuss performance, both broad market performance, kind of touch on last year, what we've seen to start the year, and then look specifically at some of our multi-asset class products and equity-only products as well. And from there, we're going to move on to kind of our equity portfolio, some specific positioning that we think is worth mentioning. And finally, as time allows, we'll move on to Q&A. And if you guys do have questions at all kind of over the course of the presentation, feel free to drop it in the Q&A. Beth and I can see that as we go, and we'll work it in either kind of appropriately with the topic we're talking about or get to it at the end. So Beth, from there, I guess I kind of want to pick up where we've left off with some of the last webinars that we've done. And that's thinking about kind of both the resiliency that we've seen from the US economy, but also what we're seeing in terms of leading indicators and what it means for our economic outlook from here.
Sure. Yeah, absolutely. Good place to start. Our base case today is that the US economy is transitioning into a recession. The Fed began the monetary tightening process with the first rate hike just about a year ago. And the effects from that take time to work their way through into the economy. So we're now starting to see those lagged impacts of significantly higher rates. We think we're progressing through what is a normal economic cycle. The past 2 cycles that we're familiar with, COVID and the global financial crisis, those were very short and acute cycles. They were more a function of exogenous events versus the monetary tightening sort of economic, cycle that we're seeing today. We are starting to see cracks in the financial system. We're starting to see weakness in manufacturing and production. We have a very inverted yield curve. We're seeing credit contraction, weakening consumer expectations, early weakness in the labor markets. And these are all the lagged impacts of that, monetary tightening process. And they're indicating that we are, entering recession territory. This is our base case. This has been our expectation. We know it takes time for these actions to work their way through. And that's why we think, it does pay to be patient, and that, now is that time, to be patient.
Yeah, and you made a couple of points that I guess first we're going to get to kind of in the coming slides, but also that I want to reiterate. And the first, and this is something that you'll probably hear, me talk about a couple of times on this, and potentially Beth as well. It's that I think a lot of market participants have been rightfully incredibly biased by the last couple of economic and market cycles that we've seen. And if you think about kind of the economic cycles we've seen, the recessions we've seen over the last 2 decades, you think about the significant drawdowns we've seen in markets, to the point you made, they've been very acute, they've been very sharp. And then I think the thing that's worth noting that's really important is because they were sharp and acute events, the Fed came in, inflation was not an issue, and they had the markets back, so to speak, right? They put a floor under equity markets, and we saw a significant rebound, and it was kind of right back to trend with what had been working before. And the thing that's going to be important to remember is that historically, that is just not how these things tend to work, right? The cycle plays out over time, the Fed hikes, significantly, and eventually something breaks. And it's difficult to tell what breaks, what is going to break, when it's going to break. It's less difficult to understand the type of environment in which something can break. And that's kind of what we saw last month, right? And that brings us to the next slide. The first thing that we really saw were the banks start to crack, and some regional banks specifically. This chart points out the significant outflow of deposits that we saw from small banks a couple of weeks ago. Now, since then, this is arrested. But the thing that hasn't changed is we've seen deposit outflows from large and small banks to money market funds, and that's going to have a real impact on lending moving forward.
Yeah, absolutely. We are just starting to see the cracks in the financial system. Interest rates, they're driving investors, to withdraw deposits in a search for yield. And this is stressing lenders, particularly the more regional banks. I'd say we think we're early in this. We're going to talk about this in a little more detail, later in terms of the impact to the regional banks. But, credit tightening has begun as a result of deposit bases, shrinking, and banks are lending less. They're doing it at higher rates, and, loan demand is contracting. And ultimately, this will slow spending and should slow inflation. But that's going to happen over time. And it really is just beginning here.
Yeah, I think one of the more interesting charts that I look at as part of what I do is when you look at the percent of net respondents being banks that are tightening lending conditions. That's a very, very cyclical chart. And once that starts moving higher, which means that banks start, making credit less available, it happens very quickly. And we are well into that cycle at this point. And if you look at that chart compared to something like the unemployment rate, there's an incredibly strong relationship. Now, with that said, there's no doubting the fact that labor markets, at least to date, have been fairly strong. But at the same time, we're also starting to see evidence of stress there as well.
Yeah, we mentioned that, some of this sort of leading indicators in labor, markets being one of those. That's typically one of the later or last things to sort of really crack in an economic cycle. And we're starting to see early signs of business, conditions weakening. Early indications the labor market is starting to weaken. Companies are starting to cut overtime hours. They're reducing the reliance on temporary help, and we've started to see large businesses pull back on hiring. Seen layoffs starting to mount up in the tech sector, more recently in the financial sector as well. Again, we think it's still early here. We think that layoffs likely will accelerate from here, which is typical at this point in the cycle.
Yeah, and it gets back to what you said. When it's typical at this point in the cycle, when you look at historical tightening cycles, typically you don't see unemployment rates start to rise until 5, 6, 7 quarters after the Fed has started its tightening cycle. And it's easy to forget that they just started raising rates last March. So we're just now lapping kind of the 12-month period. I think one thing that's really interesting is, you're right to mention a lot of the layoffs that we've seen specifically in some of the higher value add sectors in the economy, tech, financials. It was interesting to us that initial unemployment claims had remained so healthy. But I mean, just today, right? We saw them come out, revise the data, and essentially show that unemployment claims have been rising for the first 3-4 months of the year. They just had the seasonality messed up because of COVID. So I think the long and short of it here is that this cycle is playing out kind of like a more traditional and more typical economic cycle. It takes time. As frustrating as it can be, as much as we all want this to be over, this is how things tend to work historically. And it's, we can't be impatient. We can't rush things. And we talked a little bit about resilience in the labor market. it's also very true that we've seen real pain so far in the economy, specifically in some of the more interest rate sensitive parts of the economy.
Yeah, we have, I think this slide here is touching on, the fact that, in the housing market, mortgage rates have spiked to very high levels that, we haven't seen in a long, long time. I think the housing market is sort of an interesting area of the economy to look at when we're talking about the challenges, of inflation and the pressures that that's putting on the economy. Taking a step back, the underlying demand for housing in the country is very strong, due to the demographic tailwinds that are in place, in terms of new household formation. And at the same time, supply is very constrained. It's a very tight market. It's very different than the market that we, we're looking at heading into the 2007 and 2008 housing crisis. And I think what's interesting is we don't think we're actually going to see really huge declines in, housing prices here. Price discovery is really difficult in this kind of market where it's a very tight market, where rates are high, and that's restraining activity both from buyers and from sellers. No one really wants to budge with rates this high, and that leads to a lack of price discovery in the market and puts sort of a floor under prices, given the fact that you have that sort of strong demand backdrop underlying this, and the fact that you have a pretty, constrained supply situation without a lot of inventory, on the market. And so we think that creates an additional challenge for the Fed here in terms of fighting inflation. It supports the potential for rates to remain higher for longer, given that, that housing is a big piece of the inflation puzzle. So maybe some more structural support for higher rates, coming from this part of the economy.
So Beth, we do have a question that came in that I think pertains pretty well to this topic. And I know it's something that I think you were potentially going to mention later on, but how does commercial real estate fit into some of this right now?
Yeah, commercial real estate, a little bit different than the residential housing market. And yeah, we'll absolutely touch on this as it relates to the regional banking sector. I think is a good spot to talk about that some more. But absolutely something we're keeping a very close eye on in terms of the fact that you have a lot of exposure to commercial real estate lending from the regional banks. And you have pockets of the real estate market. Office is a big one, that are under some pretty significant amounts of stress, and create some challenges for those banks from a sort of lending perspective, as they need to those loans come due and they're essentially underwater. So but yeah, I can touch on that a little bit more as we move forward here and get into some questions on the regional banking sector.
Perfect. Yeah, we'll make sure to come back to that. So we've kind of set the stage, and hopefully we've established an economic outlook that is, I guess, almost understandably slowing from here, right? We're coming off of these excesses. The economy is slowing, but it's going to take time. I'm wondering how you think about this economic environment kind of within the context of what we're seeing in equity markets. We had a very painful 2022, to say the least. In hindsight, valuations were incredibly frothy. We've come off a bit. So where does that leave us now?
Yeah, sure. Valuations have come down. We kind of think of them as having returned to earth, but we're really kind of just getting back to sort of the late cycle levels where we were, heading into COVID. And, we thought stocks were expensive then, interest rates were a lot lower then. And, we think that the markets, they have been starting to sort of expect, cuts rather than further hikes from the Fed here. We probably see them at least holding here, pausing, at a minimum. So we think there's a little bit of a disconnect there when it comes to the valuations. So not seeing a ton in the markets that screams, hey, it's time to get involved in a big way here from a valuation standpoint.
Yeah, I think the thing that's interesting and important to point out, specifically with regard to kind of what we're seeing in the market from a valuation perspective, is not only is the market trading at 18 times, right? And in a typical trough multiple, when you look at historical periods, you can see that trade as, as low as 11, 12 times. Now, I think it's potentially fair to argue that with the weighting of something like tech in the index now, kind of versus what it has been in the past, with rates where they are relative to where they were in the past, like maybe you don't get down to 11, 12. Maybe you stay more like mid-teens, call it. But even there, that would suggest that in a recessionary environment, the market can come in several turns from here. And I think the thing that's even more important is typically earnings get cut 10 to 20%, if not more, kind of for the forward 12 months during a recessionary period. When you look at earnings estimates for 2023, we're in like low single digits, low single digit contraction priced in, or I guess being estimated for this year. And then 2024, you're right back to almost double digit growth off of that. So it's really difficult to look at a market that's trading at 18 times on earnings that we think probably have to come in, and think that we're seeing a lot of really attractive opportunities kind of at a broad market level. Do you think, more or less, would you agree with that?
Yeah, absolutely. Earnings expectations have kind of really just started to correct. In our view, they're really going to need to come down. It's going to be interesting going through this earnings season, as I think we start to see, some of that color coming in from the companies. It's going to drive, that activity in the estimates. Certainly markets are forward looking. They can begin to start to reflect, lower earnings before we get there. But we just talked about this on the past slide, from a valuation perspective, we're not seeing it, yet. We think that we're not really even close yet. I cover a lot of the more cyclical areas of the market. And when you look at a space like the industrial sector, things like machinery, they have benefited from really strong backlogs. Supply chain was everything we were talking about last year, right? And those supply chains, were full, and they created these really strong backlogs. The companies were trying to work through that, and it was, everything was delayed and taking longer. And so those backlogs grew and they grew. And so now you're at a point where we're at that capitulation point of, those backlogs, starting to contract, new orders are starting to decline. The companies are working through those sales, right? But the new orders are going to be what starts to drive those earnings expectations going forward. And as that starts to sort of reconnect with reality, I think is when we're going to start to see more opportunities.
No, I love that point too, because one of the things that has stood out to start the year is that the ISM new order data, both on the manufacturing side and earlier this week on the services side, has really rolled over. And again, it's another forward-looking indicator that continues to tell us that the balance of probabilities suggests that the economy has to slow from where we are. Before we move on to performance, I do quickly want to touch on bond markets. And I think the important point to make here, it's something similar, right? It's one of the strongest forward-looking indicators that most accurately historically has predicted recessions, which in this case is the 10-2 yield curve, is signaling that economic weakness is coming. It doesn't mean that it's imminent. It doesn't mean that it's here. But again, it's another kind of high probability data point that suggests to us that our outlook is justified at this point. And similar to the equity side, Beth, when you look at high yield spreads, it's tough to think that that's in the market right now.
Yeah, absolutely. The bond markets usually lead the equity markets, and, we're waiting, for that indicator of wider credit spreads, to signal sort of a more positive, environment for for equities. So, I'd say we do expect that we're going to see further widening, from here in spreads.
Yep. So from there, Beth, I think it makes sense to kind of move on to performance. And after that, we'll get back into the portfolios. I guess quickly for me to set the stage, we've talked about it a little bit. 2022 was a particularly challenging year across asset classes. That trend hasn't necessarily followed through to start the year, but I'll let you pick up and go with it from there.
Yeah, sure. Absolutely. We can see here the performance of various parts of the markets. During 2022, pretty much poor across the board. Really no good places to be. I would say, year to date, it has, brought stronger performance to the markets, maybe some of the activity this week, notwithstanding. Particularly some of the growthier sectors like technology, have rebounded this year. And I see that there's a question in the chat sort of related to this, asking about, why has, larger cap value sort of trailed the markets, year to date when it was such a leader last year. And we definitely saw a big style rotation, last year, after a very strong run for growth. We saw that really reset last year, and growth really, took it on the chin. Value did better. As we start this year, we mentioned a lot of the lagged effects of Fed policy starting to creep into the economy, and that's what investors are watching. And you've started to see the more typical, more cyclical areas of the market start to underperform, and that, sort of growth value trade sort of, taking a little bit of a flip here. And so, yeah, that's not surprising to us. I think that's what we would expect to start to see happen at this point in the cycle.
Yeah, and it kind of fits with some of the stuff we've seen in markets too, right? As we've seen more signs of economic weakness, we've seen Fed hikes priced out, which tends to be good for bond yields coming down. That's kind of the typical macro trade, right? Like yields down, growth up, yields up, value outperforms. And to your point, we've kind of seen that unwind a little bit moving through the beginning of the year. I think there's also probably just something to the idea that while the headline indices weren't down tremendously last year, the median stock, especially in those growthier parts of the market, just got walloped. I know that's something we're going to talk about kind of in the next couple of slides, but to the extent that there are names in there that people like, I think there's probably, at least to some extent, you've got people looking at companies they like that are off 50, 60, 70% from their highs, thinking like, it makes sense to be building positions in these companies again.
Yeah, sure. There's certainly, like I said, markets are forward looking, and you have pockets where you're starting to see, some opportunities start to form. I think that's definitely fair to say. I'll talk a little bit about our multi-asset class, portfolio performance here a little bit, just versus our benchmarks. Last year we had the macro call, sort of in place that the economy was slowing. We did shift to an underweight exposure to equities, probably got there a little bit late. And we were underweight cyclical areas like energy and banks, but given what I just talked about on the prior slide in terms of that value growth, rotation, we did leave, some money on the table there last year. At the same time, this year, we're seeing those sectors start to reflect the risks that we'd been really looking to avoid last year. We did have higher exposure to some higher growth, sort of higher absolute, valuation type multiple companies, last year, where some of those companies were sort of hit by that double whammy of rising interest rates, plus moving into that sort of post-COVID environment where demand had, been somewhat pulled forward, in certain areas like e-commerce, gaming, payments, things like that. Going forward, I'd say, we're running the multi-asset class portfolios, towards the low end of the historic ranges in terms of equity exposures, to be reflective of our recession, concerns. We have also de-risked the portfolios, and I'll talk a little bit more if you want about, maybe later about positioning a little bit more in detail, but
yeah, let's get to that later.
Okay. Yeah, perfect. I think the message that I want to highlight, is just patience, and we're being, we have some defensive positioning and are prepared, for the future that we expect.
And can you talk a little bit about, it's one thing to make those decisions specifically from an asset allocation standpoint in the multi-asset class portfolios. Are kind of the core equity portfolios, or the equity only portfolios that are managed by the core team, yourself included, is the defensive positioning also reflected in there?
It is. It's generally, the same story on the equity side as what I just, outlined on the multi-asset class, slide when it comes to sector and growth exposures. We've gone further underweight banks this year in our core equity strategies. That's in line with our call for a recession. We're keeping an eye on financial contagion risk there. In our core non-US portfolios, we generally have a pretty good track record there on a longer term, like a 3 to 5 year type of basis. On a 1 year basis in 2022, you kind of mentioned this earlier, but performance was impacted by specifically like the performance of a sort of handful of specific stocks. It's obviously early this year, but we are off to a much better start, this year in that strategy.
Yep. From there, maybe we can talk a little bit about kind of some of the specialized equity products. And then from there, I'm hoping we can get into some specific, industry commentary and talk about broad portfolio positioning.
Sure. Yeah, I'll talk just briefly on our disciplined value strategy. That's a strategy that focuses on high quality, stable companies with good cash flows and lower volatility. Not surprising, that's been good for this strategy, given the degree of volatility that we've seen in the markets over the past year. And then on our Rainier International Small Cap Series, I'd say that one had a tougher year in 2022. It was really mainly due to style bias. That strategy, it has generally a consistent bias towards growth in high quality, dominant type growth companies, which was a headwind to it last year. Returns have turned positive, in the first quarter this year, given the bounce back that we've seen, sort of year to date in global markets and sort of growth stocks. But, a lot of that performance is going to be tied to sort of that style bias that strategy has.
Yeah. So Beth, I think what I'd like to do from here is we're eventually going to transition to some of the Q&A that we've been getting throughout the course of the presentation. But there's two industries specifically that I think are worth mentioning. I guess from the perspective of kind of what we've seen over the course of the last year and maybe how we're positioned now. And the first one's energy, kind of energy specifically, and also commodities in general. And I can't think of a better person here at the firm to talk through this. So if you could maybe just kind of give us an overview, I guess broadly how we think about investing in commodities, and then maybe some specific commentary on different verticals within the space.
Sure. Yep. Absolutely. I can walk through our strategy for investing in commodity industries. It's a very disciplined, conditions-based strategy. We call it our hurdle rate strategy. The basis for the strategy is really a function of the returns within any given commodity industry. These returns are going to be a function of the balance of supply and demand. In an environment where commodity prices are high, that typically drives strong rates of return, for the industry participants. And this ultimately attracts capital to the industry. And that growth of capital means, new supply. As new supply comes online, it begins to catch up, with demand, and often it will exceed it. And this is when we don't want to be owning commodity industries, when capacity is flowing in and supply is growing. This is why we sold our energy exposure in 2022. The industry was really healthy, generating cash flow like it had never done before. Prices had recovered and supply was returning. And this was the point in time, where we started to exit our positions in energy. The reason is that the healthy industry, the high returns, ultimately is going to start attracting capital back to the industry. And that is typically, the starting point for the next down cycle. It's difficult to determine how long that's going to happen, or over what time frame that's going to happen, or, it can be a little difficult to predict. We don't try to, pinpoint or mark the top. We tend to miss the peak in commodities intentionally because of that difficulty. And that's what happened to us in 2022. As we, look at the situation today, that has, generally reversed. Energy has been an underperformer this year, and so it's a really contrarian strategy. We're typically, going in and establishing like the largest exposure to an industry when it is hated and everybody wants out of it and everybody thinks you're crazy for owning it. And on the flip side, when everybody's, interested and your aunt is sitting next to you at the dinner table asking you what you think about energy because, it's been so great. And, that's a time when we're typically out. So, kind of a lonely place to be sometimes from an investing standpoint. As we stand today, we have sort of the added challenge of, not only the industry being pretty healthy and in a place where it would, typically start attracting capital, But we also have a lot of questions about the demand picture going forward. We know that we typically don't want to own commodity industries heading into recessions where we know, demand historically has declined. So, right now we're just patiently waiting for opportunities to form, as we move through the cycle here.
Yeah, and I think there's two things I'd probably add. I know you wouldn't say this, but I think a really good example of the way that you guys played this within your group was energy over the course of the last cycle. It was certainly frustrating for you guys, I know, to see what happened in 2022, but it should be pointed out that in 2020, when energy was something like 2 to 3% of the benchmark, you guys had no problem with having a very, very outsized position in energy that, ended up being a very good decision at the time. And you guys were able to hold that and kind of turn around the position. And, it's at least somewhat unique to see the price of oil off 45% potentially at one point from its high, and the equities hold up as well as they have. And to your point, you guys have been rewarded for making that decision so far this year. And then a question is the way that you guys look at metals similar to energy as well?
Yep. Pretty much any commodity industry, we're going to look at, using that same strategy framework. And, it's a pretty disciplined, like I said, there's specific things we're looking for in terms of conditions in the industry to take positions, add to positions. And it's really no different in mining or the metal space, as well. And we've played, we've participated in hurdle rate investments there in the past, whether it be, copper is always an interesting one for us. Copper is an interesting one because there's sort of a secular, sort of demand story there that's very supportive for, sort of the long-term, demand growth for that commodity. And however, in the past several years, we have still seen within that secularly growing, industry, we have seen hurdle rates and we've participated in them. And so there are still cycles to be played, even in environments where you have that sort of strong, secular, sort of tailwinds to the demand side.
Yeah, so I think maybe the last thing I would say, for those who are familiar with us, based on Beth's commentary, it shouldn't be surprising that when we get into a late cycle environment like we are in now, when you look at the composition of our portfolios, more from a strategy fit perspective than anything else. And I guess you could do that specifically with hurdle rates, kind of from a sector standpoint as well. We will not own a lot of hurdle rates in deeper cyclical industries later in the cycle for some of the reasons that Beth laid out. So Beth, before we kind of move on to the Q&A that we've gotten rolling in here, I think the last thing that Warren's talking about is financials, and specifically kind of what we're seeing in the banking sector, and then how we're positioned in the space within our equity portfolios.
Yep, sure. I spoke a little bit about the deposit withdrawals, that we're seeing in the banking sector, stressing lenders and particularly more the regional banks. Commercial real estate is an interesting one to watch. We talked about this a little bit. We are starting to see cracks there. And we know regional, banks are highly dependent on commercial real estate lending. I mentioned like office buildings as an example of where there's a lot of pain right now. They're really struggling. Physical occupancy is at like 50% for those properties. And as those loans come due to be, refinanced, the properties are increasingly underwater and are worth less than what is owed on them. And we expect to see, rising defaults there. We've already seen some pretty high profile type defaults from, the likes of Brookfield and PIMCO. I think that this adds to the growing credit crunch that the banking sector is facing. And honestly, non-bank lenders as well have a lot of exposure here. We did receive a couple questions, just wondering about potential opportunities in the regional banks, and I thought it would be good if we just touch on those questions here. I think it's a really good question. Regional banks, past couple months are down, around 25% in the US. That said, we would be patient here. We do think it's still early. the banking sector does face ongoing profitability stress from rising rates. I mentioned we're quite underweight banks in our core equity strategies. We've had the failures of Silicon Valley and Signature Bank here. We've had a lot of stress at First Republic Bank. But from here, earnings for regional banks could, I think, turn up some potential landmines. It's really hard to know, exactly where those things are going to necessarily turn up. But the banks are facing an awful lot of headwinds, all at once. Deposit declines, we talked about that, higher funding costs, contraction in new lending, higher provisioning for loan losses, lower returns on capital, and then the mounting stress from the commercial real estate sector I mentioned. It's really hard to know what the stocks are pricing in and how bad it might ultimately get, for some of these banks. As we move through a recession, and kind of move forward, there may be opportunities that emerge. Bigger picture, we would probably view the sort of too big to fail, higher quality, larger, more resilient and stable banks, probably better places to be if you want to be in banks. They're in better shape to weather the storm. But regional banks they've been struggling for a long time. We probably still have too many in this country, despite the fact that the sector's been shrinking for years. It's just generally not a pond that we tend to try to fish in too much. And, we kind of find it a tough sector to invest in under the umbrella of our sort of 3 core investment strategies that we use in our core equity portfolios.
And I promised at the beginning of this that I would repeat myself kind of throughout the course of the presentation. And this is my first real opportunity to do that. So I would again just highlight one of the things I said at the beginning. It's difficult to know what is going to break or when, but it's not difficult to understand the type of environment in which that happens. And I think the regional banks are a great example of that, right? It's for all the points you made, there are stresses there. And that doesn't mean that there are not opportunities there that people can take advantage of. But I think it's important to remember that we're not just trying to capture upside returns. We're also trying to preserve capital in difficult markets. And I think with that idea kind of in mind, coupled with where we see the economic cycle, with how we invest through the lens of our strategies, I think it's pretty difficult for us to get excited about the regional banks in an environment like this. So, Beth, if we could, we've talked a little bit about some industries that we don't own and why. We've been kind of fairly bearish, I would say, throughout the course of this, both from an economic perspective and through a market perspective. But I do think it's important to, A, remember that we do still manage equity portfolios, and B, keep in mind that we are finding some opportunities. So maybe we could take kind of both those issues head on. And if you could, talk a little bit about just kind of broad equity positioning within the portfolios at the moment, and maybe address some of the areas that we are finding opportunities and kind of what we might be looking at in the coming months and quarters.
Yep, sure. I'm happy to. I mentioned we are underweight equities. That's toward the low end of our historical range that we've operated with in the multi-asset class portfolios. In our equity-only portfolios, we do have a higher than normal allocation to cash here, I would say. That's really a function of our bottoms-up process. Our analysts are looking at those, sort of unattractive, valuations or, not, the sort of so-so valuations, I guess you'd say, and then looking at that sort of, outlook for earnings expectations and estimates to come down. They're finding, that it's tough to find things that they want to buy here. They're looking probably more to reduce positions than anything. Within our core equity strategies, we are more defensively positioned from a sector, sort of standpoint. We're underweight more cyclical areas of the markets like banks, we mentioned, energy, consumer discretionary, industrials, things like that. We're more overweight your traditional defensive areas, things like staples and healthcare. It might be helpful to highlight that we don't manage our portfolios from a, sort of sector, perspective in terms of, sector allocations. We are bottoms up focused process. And so despite having, our views that we do on sort of more cyclical areas of the market, we can look within something like industrials and look at something like the defense sector, which is an area we've added to, in that basket over the last year. Broadly speaking, defense is defensive. It's generally uncorrelated to the economic cycle. It's a sector with a really strong, long-term track record of absolute and relative returns. There's a supportive environment for defense spending when you think about, what's going on from a geopolitical, perspective in terms of the tensions, not just related to the war in Ukraine, but also with respect to China and Taiwan. So really kind of a good example of how our bottoms-up process works, where, our bottoms-up process isn't leading us to own a lot of more, industrials, which tends to be a more cyclical area, but we are finding things, within there. And even within, sort of cyclically exposed areas, I mentioned markets are forward-looking. An area where we have seen a hurdle rate type of, investment opportunity form is in the semiconductor space, and we have built some exposure there. We would look to add to it on further weakness, but that's a sector that coming out of COVID just had, an oversupply situation, overcapacity, and we're starting to see the pain there. The company's starting to cut capacity, is really the indicators that we look for to start getting interested. So really a couple good examples of the fact that, we have some positioning and overlays there, but we also have a bottoms-up process that really dictates what ultimately, constitutes the portfolio. And we could talk a little bit more about this. I think maybe we have a question on sort of positioning going forward as we move into a recession and sort of move out of the late cycle environment and towards that, early cycle environment.
Yeah, I think we can come back to that. I definitely want to touch on that question because I think it's important. Before we get there, can you talk a little bit about just maybe even from a process standpoint, kind of what our analysts are doing right now in terms of building their shopping lists so that when we do get through the type of environment that we're talking about, when we do see more compelling valuations, when we do see an opportunity to step in, we'll be able to do that quickly and kind of act almost more tactically than we typically do, because we tend to be purposefully purposeful in what we do, right? But there are opportunities when we want to hit things hard. What are the analysts doing? Kind of what process do we use to be able to position more quickly?
Yep, sure. We are working constantly. We are always, even if there aren't things that we're interested in buying, we take those opportunities to build up what we call our fire drill lists. And it's really just our, sort of wish list, our shopping list for when the environment is supportive for, those kinds of things. When, valuations are, where we would be interested in, establishing positions. In our sort of favorite companies, and so every group is working towards and preparing for that pro-cyclical environment. We on the core team have been conducting those meetings with the sector groups to get their thoughts on what are you guys working on, what are you guys getting interested in or preparing for. And so it's really just a patience game at this point. We've kind of got a lot that we're teed up, that's teed up and sort of ready to go. If we get there or when we get there.
Okay. So I think that wraps up kind of some of the more, I guess, specific portfolio questions that I had for you. And maybe we move to kind of the more live fire Q&A from here. Does that work for you?
Yeah, absolutely. Let's do it.
Okay.
I think we have one question here. I could start with, actually, I'm going to, kick this one over to you. Given some of your sort of expertise on the macro and the Fed, sort of side of things, considering the recent bank stress and pressure that we've seen on deposits and liquidity there, when do you think the Fed will stop raising rates? And, when do you think the recession will begin?
Yeah, I mean, it's a tough question. And at the threat of copping out, I think that my opinion on when the Fed is going to stop hiking almost doesn't matter, right? It's what's more important is what the market is pricing in and kind of what happens from there. And really just over the course of the last couple of weeks and the last week specifically, we've seen the market move aggressively to take Fed hikes kind of off the table. Now, with inflation running almost 3 times the Fed's target, and the economy is still fairly resilient at this point, do I think that there's a chance that they're going to hike again? Yeah, absolutely. Would I bet on it? I'm not sure. But I think the thing that's important from my perspective is understanding that kind of the narrative that's been driving markets is changing, right? Like through all of 22, inflation was a problem and the Fed was an inflation fighting machine. There was a high degree of certainty that the Fed was going to hike and hike again and hike again. And the market may not have liked that, but the market knew what was coming. I think what's interesting today is that's changing. So whether we are at the end of the hiking cycle or nearing the end of the hiking cycle, kind of the path forward from here is not what it has been. And I think that introduces like necessarily uncertainty to markets, but it also forces people to start thinking about different scenarios. So like if the Fed pauses, is that positive? Is it negative? Historically, markets have done okay, kind of post a pause, but then we get into a cutting scenario, right? Like how aggressive does the Fed cut? Do they have to start hiking again? If they do cut, is it positive? Or are they cutting because something broke? And historically, when you look at hiking cycles into cutting cycles, that first cut is not, we're off to the races. That tends to be negative because of kind of the economic reality of the situation. And I think it's fair to think that that's the type of situation we're heading for. And I don't want to talk too long on this, but the other bit of the question I believe was on liquidity. So I think the other thing we're saying on liquidity is we have seen an influx of liquidity into the markets, especially in the US in the last couple of weeks. But I think it's important to kind of keep that in the context of the different programs that are ongoing, kind of the different Fed actions, right? The Fed is not expanding its balance sheet by buying securities the way that they did during a QE period. They're still running off their bond holdings, not at the same pace they were. To the extent that we've seen liquidity rise, it's really been because of different lending programs to banks in order to make sure that they have the liquidity they need to meet deposit outflows. So it's questionable whether that liquidity will find its way into markets and into the economy the way that we saw during periods of strong QE. So, that's a mouthful. I hope that answers the question, but that's kind of how I'm thinking about things right now. To use your language, clear as mud. So I guess I've got one for you now. We got a question on, since we're talking about the Fed and inflation, maybe kind of go overseas from here. How are you seeing kind of smaller and mid-cap developed market companies deal with inflation, and kind of what does it mean for their margins?
Yeah, sure. Great question. I'd say broadly, we have concerns around, growth, and that's on a global basis, not just in the US. High levels of inflation, they're already beginning to hit margins. That being said, Europe is a good example. They've already faced, massive energy cost, inflation related to the war in Ukraine last year. And those headwinds, have abated for them. In addition, the dollar has had sort of a historic bull run. The strength of the dollar looks like it has peaked, and that would be a positive for international markets, going forward. So I think in general, we may think some foreign markets are set up, relatively better versus last year, maybe versus domestic markets at this point, given the fact that some of their specific 2022 headwinds are abating. I think maybe some different foreign markets are maybe in some different points of their cycles. Thinking of something like China, Jake, I guess, given your sort of international expertise in that, respect, do you have some thoughts on sort of where we are with respect to reopening in China? What might that market look like going forward?
Yeah, I mean, I think there's no question that for a while now, China has stood out relative to other major economies in kind of not only how they approached their response to COVID, but kind of where they got to more quickly in terms of monetary policy and fiscal support for the economy. So you never saw the massive fiscal injections that contributed to some of the inflationary pressures in the West and China. You saw almost 3 years of lockdowns. And I think the simple reality of the situation is, in a communist country where people can't go to a voting booth and voice their frustrations, one of the things you have to be cognizant of is the need to improve people's lives. So kind of consistently, so they don't feel the need to have an outlet. So we started to see, and not just driven by that, but we started to see fiscal and monetary support in China before any other market. I think their economic cycle kind of got desynchronized from the rest of the world. And there's no question that they're kind of early cycle now, where the rest of the world is, more late cycle to troughing, maybe in Europe. I think the question about China now is how strong is their recovery going to be? And given some of the issues that they have with leverage, specifically in the property sector, I don't think that they're looking to juice the economy the way that they have in the past. Now, that doesn't mean we're not going to see a potentially strong upcycle, but I don't think we necessarily want to extrapolate exactly what we've seen before in China to what we could see moving forward. I think the other thing a lot of people are excited about is, the excess savings that have been built up in China. But again, the thing to remember there is that the social safety net they have in place, say what you will about what we have here in the West, it is significantly better and I guess more expansive than what they have in China. And it would make sense to me, given what we've seen over the course of the last 3 years, that if people came out of that and thought that they potentially needed a bigger savings cushion than they had before, like that's something that would certainly make sense to me, right? So I think the long and short of it is the Chinese economy improving? Yes. Do we think there's potentially some investable opportunities there? Yes, but this is not kind of the off to the races necessarily that we've seen in the past. And I guess that kind of maybe brings us to, well, maybe 2 more questions, Beth. One that we got specifically on global shipping. I think you're well suited to answer, and it relates to what we just said about China, what we said about the US economy. So if you maybe want to touch on that quickly, and I'll throw one more to you again after that.
Yeah, sure. It's kind of a broad question that, I think is, the way I would answer it is, when asked what I think about global shipping in general, tough environment that we're in, here, from an economic standpoint, from a flow of goods standpoint, things like that, are certainly, playing into the headwinds there. When we look at the sector, there's areas that, we like a lot better than other areas. When you look at something like the rails, really attractive companies, a very consolidated industry, companies with very strong, pricing power, despite the fact that there's some cyclicality in those businesses, they really fit very nicely with our profile strategy. And so we have actually started building a basket of rail companies in the portfolios, given that they have pulled back quite a bit, and are starting to reflect, I think, the economic slowdown that we're, expecting. We're going to see something we'd probably look to add to as we move, closer towards a more early cycle environment. I think of transports generally, and shipping falling into that as well, as just more of an early cycle, type of recovery, type of sector that, that there's some really great companies in there. There's some, some good areas to look at. Logistics, I think is one area. Trucking is going to be an area that's probably going to be best suited under more of our hurdle rate strategy. It's a really fragmented industry. It's just doesn't have the sort of strength supporting it that some other parts of the sector have. But yeah, good question.
So, and I think your answer leads well into what I want to be the last question that we pose here. Again, we've talked about, a fairly difficult outlook from here, a challenging environment for equities, especially kind of more cyclical equities. But when you think through to the other side of that, we've touched on this quite a bit. So maybe you can just kind of briefly summarize your thoughts in terms of what it is you think that we want to own coming out of this, and maybe speak in broader terms. And is it going to be similar to past recovery environments?
Yeah, sure. It ties in well with the conversation that you posed about, sort of how we get ready and the fire drill list that we have, that we work on. When we get to an environment where, we think it lends itself well to pro-cyclical positioning, we have a whole host of early cycle, types of companies really to choose from. Oftentimes those are, going to be sort of like your smaller companies, your earlier, sort of more cyclical, like the greater sensitivity to the economic cycle, possibly commodity players, all likely to do well, as we move through a recession and into an early recovery. That's the work we're doing today. I mentioned some areas, some initial exposure in rails, some initial exposure in semiconductors being a couple of those. As we move forward, you'd expect us to see, more opportunities in things like industrials, chemicals, building products, home builders, machinery, and then outside of that sort of, my area, but, consumer discretionary type, areas of the consumer versus like more the staples exposure that we have today and whatnot. So yeah.
Well, I certainly appreciate that, Beth. And I guess with that, we've kind of come to the end of the time that we have for today. I want to make sure that I, thank everybody for taking the time to be with us. And I want to be respectful of the fact that we said we'd go about an hour. If we didn't get to your question, we'll absolutely follow up with you after the presentation. And as a reminder, for your convenience, a recording of this webinar will be emailed to you shortly. Please feel free to continue to reach out to anybody here if you have questions or there's specific follow-up you'd like. We'd also really appreciate it if you guys could take a few seconds and fill out the survey that we have linked in the chat. So Beth, thanks a ton for being here today. And to our listeners, thank you all for attending today's webinar and giving us some of your time. I know everybody's busy and, that time's at a premium.
Thanks very much, everyone. My pleasure to be here.